one. Acceleration, Dave. 2010, 2011. So tell us what's happening.
Well, you know, last year was the fourth in a series of years where every year there was something that just kind of got in the way of the market's momentum. Just when it felt like we were starting to move forward, an event would occur. Last year's event was the second expiration of the tax credit in April, and then, of course, for closings in June.
Right.
And we saw activity just fall off the cliff and not really recover. All the economic indicators this year going into 2011 are on the upswing, almost every one. You look at unemployment rate, although it's not coming down as quickly as we'd like, it's still coming down. The employment levels are going up. Stock market's back up very close to you know, where a lot of people thought it should be. We're seeing inflation tame, interest rates low, consumer buying great, car sales starting to get better. So there's a lot of indications that the economy is on a slow upward path. And with all those things coming into place, it just seems likely that we're going to go through a year now without any significant event that will just throw a wrench into home sales once again. If that can happen, then I think what we're going to find is that the level of activity and the health of the market a year from now is going to be much better than it is even now. That we're going to start to see that slow, steady acceleration from here to where we want to be, and that's what we're looking for.
And yet affordability remains quite good for many people.
Affordability is at an all-time great. It's the National Association of Realtors publishes an index they call their affordability index. And it's a very simple index. What they do is they take a look at the median price in your market and they compare that to the median family income, factor in interest rates, do a little formula, and figure out what percentage of income the average family has to afford the average house. And here in Dane County, about 5 or 6 years ago, it was as low as 117, which means that the average family has 17% more income than required by the average house. Now it's up to 144.
Wow.
Yeah, and if you get to, and it's even higher in other parts of the state. Right. If you go to Sauk and Columbia County, it's approaching 200. So what this means is that we've had flat to slightly down prices, as we've discussed in earlier videos and earlier newsletters, for a few years now. Interest rates remain at an all-time low, so the buying opportunity is terrific. One other thing that I think should be borne in mind, as you read the newsletter, you'll see a map there done by Case Shiller that shows how long they predict it will be until housing markets return to their peak.
Right.
And what they're predicting for our market is that our peak prices will be regained in 2 to 3 years, which means that from here over the very medium term, prices are likely to be moving up, not sideways or down. So even if we see some technical blips here over the next few months, over the next 2 to 3 year time horizon, we should see prices up, if that prediction holds true, I'd say 5 to 7% higher than what they are right now. So that's great.
And you also referenced bottom in your newsletter a few times.
Well, you know, this is something that buyers and I think the media and everybody's been kind of obsessed with has the whole housing market hit the bottom?
Right, right.
Well, you know, how do we know? I mean, what is the bottom? It, really, you know, it's a theoretical place. Right. I mean, it's that place where when we go back and we look and we say, well, this is when prices are at their absolute lowest. But what any professional investor will tell you is that you never know where the bottom is until it's in your rearview mirror.
Of course.
And so, you know, when will the bottom happen? Well, we'll know when we look back a year from now and say, well, it looks like that was about the low point.
Right.
Are we there yet? I don't know. It might be now. It might have been 3 months ago. It might be 3 months from now. The point is, 2 to 3 years from now, prices are going to be higher than they are now based on all the predictions that we have from credible sources. And if that's true, then buying now means you're going to be better later. And whether you hit that absolute bottom, I don't think that's something that somebody should worry about because it's not knowable. Rather, what I would focus on is the fact that affordability is high, prices are predicted to rise. If you get in now, you're probably going to be in a good place. Plus, let's not forget interest rates. That lowers the cost of your buying. Even if prices remain flat, if interest rates rise, your cost of owning will go up. So there's really not a lot to be gained by not taking advantage of the current circumstances and waiting until things get better, which they most definitely will.
Exactly. Now, you mentioned earlier that for sellers, their listings were down recently. So
it's very interesting, and we don't talk a lot about that in this particular newsletter because we had to publish it before this came in, but the number of new listings to the market in January this year is down almost 30% from a year ago. Now, I think they spiked. We noticed a spike up a year ago. We mentioned that in a previous issue of the newsletter a year ago. Inventories and the number of new listings spiked way up about 30 or 40% last year. We think the tax credit that was
Sure.
extended might have drawn people in. It was made available to repeat sellers, repeat buyers in the second go-around. So there may have been people that said, okay, I'll try to sell in this environment. If I can sell, then I'll buy, get my tax credit. Obviously, it worked for some people, it didn't for others, and so what we saw in the fourth quarter was a big drop in inventories. And now we're seeing fewer new properties coming on the market. That's good news. That's going to accelerate that price increase because inventories are going to continue to shrink. So we seem to be back on that slow downward track for inventory. So that's another good healthy sign.
But it also has implications for affordability again, right?
Absolutely, it does. Never will it be more affordable than it is right now in all likelihood. The combination of interest rates and prices, as inventories start to go down, prices will level and start to rise. And so this is the environment you want to take advantage of.
So for buyers, then, get rolling. It sounds like.
Oh, for buyers, well, we've been saying this for a long time, and we were right then, and we're right now. It's the time to buy, and the environment is very favorable. We understand the psychology of it. I mean, we've been watching it for a long time, and people need confidence. You sort of need to be one of those bleeding edge types that's willing to jump in when you don't think that the environment is as positive as you think it should be. But the environment is in fact very positive, and our guess is that if the economic news continues to get good, there's a good chance that within a fairly quick period of time, within months, not years, we're going to see a lot of momentum start to come into the market as people start to realize, hey, this thing is starting to roll here, and if that happens, we're going to be in really good shape.
So what about investors? What's happening with them these days?
Well, investors, they were a big part of the landscape, particularly in single-family housing. I don't mean to sound pejorative to investors, but there was a lot of single-family home buying for investment purposes. It added a lot of demand to the market that probably tended to push the market and overheat it a little bit. We haven't seen as much of that come in. What we are seeing, of course, is that there is some activity in foreclosures and short sales. There are some distressed properties even in this market. And because of that, what we're seeing is some investors coming in and taking advantage because they know these are very favorable buying opportunities, and the pros are getting in and trying to snap up some of the real bargains, and it won't be long before the rest of the population follows along.
Right. So back to those buyers again. The deals are out there if they, if they look.
Oh, absolutely. They have been for some time.
Yeah. And how about financing? What's the financing market?
The financing situation right now remains a challenge. Not because there isn't any money available, but interest rates aren't this low if money's not available. So there's plenty of money available, but they're very, very picky about lending it out. That doesn't mean it can't be done. We're not saying that you can't get financed. What we're saying is that even if you have good credit, a good down payment, and everything looks like it's right, they're still going to make you jump through all kinds of hoops. The process has just become very, very difficult, and the appraisal process has become somewhat unpredictable. So we're seeing properties that have been selling for great prices, even very reasonable low prices, and then the appraisals still come in low, which is just very frustrating, and so then we have to work with that. And eventually we get there. All we're really saying to buyers is be prepared for the difficulty. Don't be insulted. It's not you. You're fine. It's just the process we have to go through right now. And if you can endure it, you get to the other side. Everything will be fine.
So it sounds like your use of the term acceleration is a good one for 2011.
That's what we hope, and that's what we think. It really looks like the stars have aligned now where we just don't have the interventions. Not to go back to the tax credit again, we keep talking about it, but when that first was put into place, we were hopeful that that would kickstart the market and give it the momentum that it could fly on its own. It didn't. What it did was it robbed sales from the future, and it caused a false spike in activity followed by a drop that gave the impression that the market was still really struggling. We are not going to have that kind of intervention anymore. Without that kind of intervention, there's a very good chance we'll see a normal seasonal curve. And if we can see a normal seasonal curve where people are coming into the market for the right reasons, inventory is slowly falling, I think there's a good chance this market's going to accelerate through 2011 and really be ready to roll in 2012.
Great. See you in a quarter, Dave.
You bet. Thank you, Jim.